Hello, everyone. I hope you're having a great time so far at the London Summit. In this next session, Roadblocks and Building Blocks for Institutional Crypto Adoption, our industry experts will break down setbacks and opportunities for opening up digital assets. Madeleine Boyce, Head of Community at GBBC Digital Finance, will be moderating this session. Madeleine, the stage is yours.
Thank you, Despina. Hi everybody, my name is Madeleine and I head up the community for GBBC Digital Finance. We're the financial services arm of the Global Blockchain Business Council and we're the largest blockchain and digital asset association in the world. It's my absolute pleasure to be here at Finance Magnates today and introduce this panel on roadblocks and building blocks to institutional crypto adoption. We have a 40-minute panel with quite a few panelists and a dense topic to cover, so I'm going to jump right in and ask Ian to introduce himself.
Yeah, thank you. So my name is Ian McAfee. I'm the co-founder, CEO of Shift Markets. We're a technology provider that helps institutions adopt crypto with a turnkey tech stack.
I'm Shannon Kurtas. I'm product director with Kraken Exchange. I'm looking after our pro and institutional products. Prior to joining Kraken in 2020, I spent a number of years building and operating a crypto proprietary trading firm that spun out of a hedge fund here in London called Brevan Howard. And prior to that, spent a number of years in traditional finance trading interest rate derivatives.
Thank you very much for having me. I'm Laurence Willows. I head up business development for tastycrypto, which is one of the digital asset incubators that IG run based over in Chicago.
Hi, my name is Aditya Turakhia. I work at Ripple in the institutional markets team, covering a broad range of initiatives around liquidity, trading, and risk management. Ripple, for those of you who don't know, is an enterprise software company that solves real-world problems using blockchain technology. Prior to joining Ripple, I spent most of my career in global markets roles in traditional finance, mostly in the FX space.
Hello, everyone. Great to be here. I'm Chen Arad. I'm one of the co-founders and chief external affairs officer of Solidus Labs. Citigroup named us about 2 years ago category definer for crypto market surveillance. We specialize in detecting and preventing various sorts of market abuse and market manipulation, specifically in crypto and digital assets and DeFi. We work with some of the largest platforms in the world, traditional financial institutions that are beginning increasingly to offer crypto, and we'll touch that today, as well as regulators. And are also very active on the global policy front, trying to regulate this space in a way conducive to growth.
Well, thanks, everybody. So if we're going to jump right in, this panel is really split up into two sections. So we have the roadblocks and the building blocks. Now, I want to start with the roadblocks, and within that, I think that we can also sort of angle it around two sides. And we know from the other panels this morning that panelists have been talking about regulatory challenges, and this isn't a reg panel in my mind, but I do think that we need to touch on it a little bit. So, Laurence, I was wondering if I could hand over to you to talk a little bit about your perspective of regulatory challenges, particularly as an individual that's based out of London, but with a team based in Chicago. It must be interesting seeing the two sides of the pond in that sense.
Yes, absolutely. I mean, regulatory clarity globally is on a very varying scale of maturity. So if you look east of the pond to the UK, Europe, Asia, you can see that there is a huge amount of maturity in some markets and definitely a forward-looking approach from regulators. So, I mean, bringing closer to home in Europe, you've got in June this year, MiCA came out with their regulations from the EU, which is obviously a huge step forward for companies operating in Europe. In the UK, the FCA has taken a forward-looking approach as well, despite some of the sort of difficulties that a number of sort of less mature organizations are facing around still getting bank accounts and that sort of thing. But what you're seeing is it's really paving the way for mature businesses. So with the marketing promotions regime that came out and into force only 6 or 7 weeks ago, very similar to what you see in sort of traditional finance space, where it's regulated institutions that are allowed to market to a number of sort of retail customers. Going over to the US, and obviously it's a much different dynamic. So the SEC has come down with enforcement to a large extent without giving any clarity really to a large degree. And I know there's a number of our panelists here today, but you've seen institutions such as Ripple obviously going against the SEC and sort of winning one of the lawsuits there, and a number of institutions really having to battle the SEC. But it makes it difficult for less mature firms to really have the balance sheet and push against the regulator, which is not the way that you want to operate.
Yeah, I can understand that, and thanks for the balancing act in terms of insights there. Chen, I was wondering if I could turn to you and ask for, like from a market surveillance perspective, if you're able to draw any patterns between, how regulatory clarity is influenced or not influenced institutional crypto adoption.
Yeah, well, I think Laurence, covered it very well and concisely. I'll start with some optimism. I think there's a tendency generally in the world, definitely in the financial industry and specifically in crypto, to forget sometimes that we tend to overestimate what can be done in a year and underestimate what can be done in 10 years. That question of regulatory clarity is definitely a huge frustration. People don't only want to know what they can do, they also want to know what they can't do, and it's very blurry at the time with this mix of a lot of great progress we've seen over the years in terms of more regulation, more regulatory framework legislation coming in, not only in Europe but globally. I just came back from Singapore. APAC, in many jurisdictions there, has some of the most advanced frameworks, but crypto specifically is so cross-border that it's great, but it's also not. It doesn't exactly solve the problem that you have like things. Clarity, let's say, in one specific place. Lost my chain of thought there. Anyway, I started by talking about this tendency to always want things to happen very, very fast. Regulation has been evolving. If you look at it from a 5 or 10 year perspective, it's actually evolving. Regulation for crypto assets is actually evolving faster than I would say almost in any other asset class in history. It's never fast enough for industry. What's frustrating is that you're seeing a lot of firms that are really trying to do the right thing, and oftentimes they're the first one that get targeted because they're easier to identify and target. And of course, when it comes to institutional adoption, that makes it very, very difficult to understand where institutions can step in. Wherever regulation is clear, I think we see a ton of institutional engagement. But I don't know. I just heard about a firm that's not based in Europe and operating completely within regulation, that happens to also have an office that doesn't even offer digital asset services in the United States, and is starting to get contacted by regulators there. So in general, it's a huge challenge. On the market surveillance piece, as part of that increasing progress, you're seeing regulators moving at an accelerating pace from what I think is as kind of like the doorway into crypto, into becoming regulated, KYC, AML, making sure you're not accepting money that comes from problematic places, to more comprehensive frameworks. And as part of that, market manipulation is really something that regulators have been giving more attention to. You're seeing it in MiCA here in Europe. You're seeing it at the FCA's consultation, which is due to be re-released later this year, and beyond. So clarity, I completely echo Laurence's point, is key.
Clarity and looking at it from a 10-year perspective. You made the point in Singapore as well, where you can be very frustrated about the lack of progress that we've made in a year, but when you look at over the course of 10 years, what we've actually achieved as an industry is pretty incredible. So I'm going to keep that tone of optimism for the rest of the panel, hopefully. But I wanted to turn to Aditya, Shannon, and Ian. All three of you have very robust traditional finance backgrounds, and so moving into the other side of the Roadblocks angle, which is, from my perspective, an infrastructural roadblock. Aditya, I was wondering if you could kick us off with, your thoughts around what are the infrastructural challenges, barriers to entry for institutions, not only looking to dibble and dabble in crypto, but really scale that from their own organization.
Yeah, I think this topic is very relevant for most institutions around the world. And we're not limiting ourselves to just traditional institutions, but also crypto institutions who want access to traditional products. So we talk to a lot of crypto native institutions on a daily basis who want access to FX, who want access to bonds, who want access to traditional instruments to hedge their exposure, to earn yield on their balance sheet. And so they have a similar problem. They're not able to get onboarded to traditional assets. And so the ecosystem that they have access to is the crypto ecosystem or blockchain technology to access these tokenized real-world assets. So it's a two-way street in terms of challenges. Crypto natives want access to, let's say, tokenized bonds so that they can leverage composability and smart contract functionality on the ledger while getting access to these products. For institutions on the more traditional side, when they're coming in, for them, there's not the breadth of instruments available today. There's T-bills, there's some money market instruments. We're seeing life in that space today. We're seeing stablecoin movement. But we've only scratched the surface in terms of the breadth of instruments available for institutions to come in. So let's say we take challenge number one, availability of instruments. We solve for that. Then we have the second problem for us, which is around liquidity. Can we, in a world where there's fragmented liquidity between decentralized exchanges, OTC, centralized exchanges, actually bring traditional institutions to be able to gain that exposure on-chain and leverage its benefits in scale? That's something that we have to also figure out. I think another challenge that most institutions face is on the custody front. Being able to get used to a world where an on-chain transaction could be irreversible, but also the operational process around managing your own keys, the security that comes with it, and what kind of technological integrations do you need to multiple venues to access this ecosystem safely. And lastly, I think the joining glue between all of these components is compliance. I think one thing that institutions are particularly sensitive to is they want to know who they're transacting against. KYC, AML, of course, at the surface is very, very important. Lots of solutions coming around to solve some of those problems. But also monitoring activity after you know who you're transacting with. Suspicious activity reporting or market abuse, like you were talking about, are important, let's call it prerequisites for institutions to get comfortable to enter. So, I mean, knowing the challenges is the first step. There's lots of firms trying to address it. So I feel pretty optimistic that we know what the challenges are amongst all of what we're doing. We're just going to go after it and try to tackle them one by one.
Yeah, I think I would echo a lot of what Adi said here. There are certain inherent complexities and difficulties with accessing crypto for individuals and institutions alike. One of those things is increasingly scale and trading infrastructure. So of course blockchains are inherently slow and relatively expensive. We at Kraken handle a wide variety of clients, including the sophisticated high frequency trading firms who are used to transacting hundreds of thousands or millions of times per second. That kind of scale does not exist on chain. It cannot exist on chain at the moment. And so I think centralized exchanges, prime brokers, trusted counterparties have an important role to play for market access and then facilitating that trading. Second of all, it is it's complex and operationally difficult thing to undertake. Custody is a relatively unsexy, commoditized product in traditional finance. Much less the case with crypto, of course, as Adi said. These are bare instruments. If you lose the keys, they are gone forever. There's no one to call for help. And so that's the case for, of course, the major assets, Bitcoin and Ethereum, but also the case for, the other variety of blockchains that exist that are more difficult to interact with. They may have, bridging between different blockchains, different settlement mechanisms, and this is not something that every institution is going to do directly. And so they will rely on custodians and exchanges to facilitate access to these markets. Third kind of related point is security. In many ways, this is a cybersecurity business. It's not just trading. Kraken often feels more like a cybersecurity company than an exchange. I joke. I think that is that requires in-house expertise, requires experience, And yeah, the number of experts who are really leading this space, you can probably fit into this room quite comfortably. So it's a very fast evolving market, and having a security first focus is important.
Yeah, echo a lot of those points. Cybersecurity, the stakes are so much higher, right? The money is right there for the attacker to take. I think just another point too about institutional adoption. I mean, remembering that crypto came from a sort of a retail phenomenon, right? It's has almost like a religious-like following. Bitcoin has this sort of freedom-oriented mindset about escaping the financial system. So to get that into the financial institutions is a little bit of a journey, right? You have, on one hand, a crypto-native, crypto-first type of person who cares a lot about the values of crypto. They care about their freedom, the financial security. They care about being able to move their money when they want to. And then you have the institutions with they kind of have the power now, right? So how do they really get on the same page as someone who's coming in saying, I want to leave you? So the use case between financial institutions and crypto people has to have a common ground. Another point there too, I mean, within the crypto community, there's still a lot of conflicting beliefs and policies, and I think which chain you like and that sort of thing is a little too divisive for crypto. And I think remembering that they're kind of all in it together is an important thing, especially when compared to the traditional financial ecosystem. And I think that's starting to work itself out a little bit more, but it's definitely caused problems, I think, for larger institutions to adopt crypto. Another thing is just, I think mentioned here, but the critical infrastructure you need, right? The cybersecurity, they're just new tools, right? When any new asset class, there's going to be new things you need to do. Compliance was mentioned. Like, you can do now compliance on chain, right? You can see a lot more if the regulators truly understand that they can follow the money better than they can on the old system. It might make more sense for them to do so, and I think they're starting to get there. But it's mostly education, right? It's just getting the narrative straight between the crypto native and the financial institution, and finding that common ground, and finishing building this technology infrastructure. So we talk to our clients are like financial institutions, and we help them get into crypto, right? We give them a platform, and they come in with questions like, well, who do I go to for this? Who do I go to for that, right? And they don't know the players. They're not household names yet. And as those players get larger, I think you're going to start to see more and more adoption.
Thanks, everybody. And I mean, aside from obviously the very important infrastructural pieces like custody, breadth of assets, liquidity, I think the human element that you brought to at the end and sort of harmonizing discourses, which can be very polarized within the crypto space, is super important. So thanks for bringing that up. I want to turn to looking at sort of the transition towards the building blocks and what we're doing as an industry to really push the dial forward. But during our panel prep call, I mean, I had a moment where I laughed when Chen brought up, like the when is always the $1 million question, but it's actually been going on now for the past few years. The institutionalization of crypto has been on the headlines since 2017, if not before. And we've had building block moments in the past few years. I'm sure I don't need to tell the audience, the BNY digital asset custody trading desk, for example, other banks' actual trading desks that they're working on. These are all examples of institutions making moves in the space so that they can open those services up to their customers, their existing customers. But Chen, maybe if you could just segue us into the building blocks bit by giving us your view on sort of where we are at the moment in the industry, and what are key developments that are driving us right now into sort of a more institutional setting for crypto.
Yeah, no, I do joke often that since I joined this industry in 2017, every single year has been the year of institutional adoption. And one way of looking at it is that, all of them actually were, in the sense that there is ongoing institutional adoption. I think just as humans, we tend to kind of seek watershed moments, the before and after, but in truth, it's a gradual process. I really like, Fidelity releases a regular survey of institutional investors, Fidelity Digital Assets, and the numbers there are quite remarkable. As early as, I believe, 2020, 2021, already 4 out of every 5 institutional investors surveyed, and they surveyed thousands, said that they're involved already in some way, they deploy to a certain degree, and they expect that deployment to grow. There are very specific things that they consistently, bring up as the challenge. One of them is regulatory clarity. As an institution, you simply, you're not in a position where you can ask for forgiveness. You need permission. Another one that obviously is very relevant to us is, to us specifically at Solidus, is market manipulation. Obviously, market manipulation is also deeply connected to efficiency of markets, best execution, et cetera, which is a big blocker. I'll speak from our vantage point. We work with. It's really important for me to stress. I can't stress enough that the crypto industry is not what it was 5 years ago. And it's not even what it was a year ago. We work today with, with risk and compliance teams that are larger than the risk and compliance teams in many traditional financial institutions, because the crypto industry really put a lot of resources behind, trying to provide safe and regulated and compliant, opportunities for the public and for institutions to invest. A lot of the people staffing, by the way, those compliance teams, market surveillance teams, come from traditional finance, from NYSE and NASDAQ, et cetera. So they're really smart people that's been working for the good part of the past decade, really trying to push at least the centralized part of the crypto space towards more institutional, compliant places. So in that sense, the compliance is a critical building block that, as a number of you have mentioned, is already, I would say, in place. It's missing some of that regulatory clarity to know exactly what it means to be compliant. But a lot of it is preemptive, and there's really an attempt to do the right thing. On the DeFi side of things, decentralized finance, I feel like DeFi today is more or less where CeFi, centralized finance, centralized crypto trading, was 5 years ago. It's also important to say that 90% of crypto trading activity is centralized, even though we love to talk about decentralization. But the commitment in that part of the industry to compliance, and also that has been brought a number of times, is really there. And there's also a lot of demonstration, as you mentioned, that there are actually a lot of ways in which compliance, risk monitoring, surveillance can be done in a more efficient way on-chain. So we really are getting closer to this building block of sufficient cross-on and off-chain ability to understand risk, understand the fairness of trading, being in a place that I think is not far behind, maybe in the not too far future, even better than in traditional finance, because we should never forget that it's not like market manipulation, market abuse, frauds, and meltdowns were invented by crypto. So, for us in the industry, I think it's fair to say we actually feel it can be done better through that important building block of compliance and risk monitoring.
Thanks, Chen. And Ian, maybe from a crypto as a service provider, I don't know if you have anything to add on that train of thought.
Yeah, I mean, I think as an institution, you're looking at this space, and I mean, one question you have to ask is, how do I make money in the space too, right? You're going to take all this risk, and you get into this new technology you don't have the people for, and you don't understand. So there has to be some sort of reward there. And I think those new ways of real-world assets coming on chain and other things that, because crypto is an asset class, but it's also the blockchain is a way to interact with other financial instruments, right? So as you get acquainted with crypto, you start to be able to look at these other products that might not have easy access points and get to them through crypto rails. Being cognizant, we're at a retail FX conference, or historically one. Derivatives are also very popular, and I mean, the companies that made the most money in the space, despite where they are now with FTX and BitMax, they made billions and billions of dollars very, very quickly. And crypto derivatives and other financial ways to interact with crypto are needed, so you can extract more value out of the ecosystem. So we're launching a crypto derivatives platform now, and getting more people educated about how to trade these products, so you can actually make money in this space. Because I think that's one thing that institutions are looking at. Like, there's a lot of risk, but where's the profit, right? So I think that understanding that is a key to, these companies taking more risk to get into the space.
Yeah, I think it makes a lot of sense. I mean, you really need to be looking at the value proposition from the other side of the pond in that sense. Want to move on to the building block section now and I think a lot of it is quite logical in the sense that we've looked at what the roadblocks are, what the barriers to entry, and all of you gave some fantastic insights there. So I think building on all of your responses, I think the question really is, how do we turn those into building blocks? Like, what can, individually we do in terms of representatives in the industry to create the infrastructural building blocks that we need, and I think also educate on that front too. So Aditya, maybe if I can turn to you to sort of start that building blocks narrative, it'd be great to hear your views.
Yeah, sure, happy to. When I think about Ripple, we work with tons of institutional customers on a daily basis, whether it's for cross-border payments, custody, tokenizing their assets, and doing more on-chain. For us, we think of our building blocks in probably 4 or 5, depending on how you look at it. The first building block is on-ramps and off-ramps. And so similar to how we all have cash today, we deposit our cash, it moves into the banking system, or we withdraw it from an ATM, it comes out. It's actually a transfer of value into an ecosystem which can move value digitally in some shape or form. So the first thing that we need to do in blockchain technology is to on-ramp that value either from the traditional world into a blockchain environment, or from a bank account into an exchange environment. On-ramps and off-ramps provide that pathway for value to move into and out of that ecosystem. So that's the first building block. How do you get value into that blockchain ecosystem? The second one is tokenizing those assets, or tokenization more generally speaking. So if you are able to take that value, you then tokenize that value into smaller building blocks. They can then be composable, and smart contracts can actually interact with these building blocks. It could be posting value as collateral to borrow assets. It could be exchanging assets. It could be providing a perpetual exchange. It could be absolutely anything. It creates those building blocks for you to interoperate on. The third building block then, once you've tokenized your assets, then becomes custody. You need to be able to hold your assets in one place. And so providing custody tech, Ripple very recently acquired a company called Medico that works with some of the largest banks out there to provide custody tech, to abstract away all the complexities with dealing with your keys, security-related issues, and how do you manage integrations into multiple blockchains that have seemingly different technology. So holding your funds or being able to interact with these objects through your custody offering was very, very important. And so now you're able to hold your assets. What do you do next? You need liquidity as the fourth building block, which could be in the form of a decentralized pool. It could be a decentralized exchange. It could be venues, centralized exchanges. It could be a number of different venues, but facilitating commerce on these liquidity pools, particularly for blockchain assets, becomes increasingly important. And then again, to come back to compliance is the fifth glue to bring this all together. Again, for institutions to get comfortable, you have decentralized ID, ZK proofs, helping people identify the authenticity of various customer groups. Also, on the XRP ledger, we have functionality like authorized trust lines, so you know only a certain group of participants can interact with certain tokenized assets. So these building blocks, when they come together, give institutions a pathway or a roadmap on take your product, use this technology, and now the world's your oyster because you have the building blocks and the puzzle pieces. It's how you bring them together to extract value for your end customers.
Yeah, I agree with a lot of what Adi said. Custody is fundamental, 100%. And I think regulatory clarity is going to be the buzzword of the day. So custody, it's not just one-size-fits-all solution. That means individual custody, institutions who are going to be using a qualified custodian, and therefore having the service providers manage the key material on their behalf and all the associated complexities. It could be a technology provider like Montaco, GK, et cetera, who are providing technology to institutions who are willing or able to run the technology themselves, and kind of a spectrum of companies in between. Doing so in a clear regulatory framework. So in Europe, there's increasing clarity in the UK and with some of the VASP licenses, and especially will be the case in 2 years' time when MiCA is in effect. In the US, it's not as clear at the moment. We have a number of large custodians operating as non-bank state trusts, one as a federally chartered trust, and a number of regional banks. So very hybrid, a tapestry of applications and frameworks in the U.S. Secondly is liquidity, as Adi mentioned, and that's just that's a number of things. That is access to the instruments that you need to trade to be able to effectively get exposure to different digital assets, hedge your risk to those assets, and do so in a cost-effective manner through the use of leverage, but also having market depth. And I think especially after FTX, we've seen a consolidation of liquidity, and I think Kraken's been one of the few venues that has seen an increase in top-of-book liquidity available for trading year to date. Connectivity is another thing, and interoperability, and that means a couple different things. One is systems connectivity, so having ways for institutions to connect directly to these venues and counterparties in a way that they're used to, and a way that is compatible with other systems. So this is the biggest reason why Kraken, as well as other venues, have launched fixed APIs. This is the language that people are used to speaking in terms of systems. And interoperability in terms of on and off ramps is certainly the case. And then lastly, I would say security and compliance as a general catch-all bucket. So, if you are a institutional asset manager or a hedge fund manager, you need to be able to demonstrate to your investors how you are managing their funds in a compliant manner, how there is separation of concerns, due diligence being done in a proper way, reporting done in a way that they need, and I think these things together kind of combine to allow institutions to interact more efficiently.
Anything to add, Ian?
No, I agree with all that. I think we're getting there. I think there's, as Chen said, it's been slow. Every year there's larger and larger institutions getting into the space. 2017, you had the early stage gritty entrepreneurs, right? And then every year after that, it's gotten bigger and bigger until now the largest asset managers in the world, the largest brokers in the world, the largest banks in the world are looking at crypto. We're talking to them. We see them looking at the space. It's happening. It's just not. It's happening in a staggered way, right? And I think over the next few years, we're going to see some of the biggest financial institutions be in the space, and it's here. It's one announcement at a time.
No doubt about that as well. And I think, what's really interesting is the angle around the infrastructural building blocks that all tie into just strong compliance and security. Custody in itself, sure, it's infrastructure, but what does it tie into? Security, compliance, trust in the tech stack that's being used. So I want to turn to Shannon now quickly. I know that we're running into the last 10 minutes of the panel, but from your perspective, with the clients that you have, what ways can you best convey what the risk mitigation strategies are around that? How do you foster trust in the infrastructural building blocks that we've been discussing? The trusted providers that we all know. Ripple was mentioned not long ago. How do you create trust with institutional clients in that respect? And how do you convey best practices better to them and to make sure that there's appetite to really continue to grow in the space?
I think one is being very proactive with regulation and compliance. As Chen said, you can no longer ask for forgiveness; you have to ask for permission. Kraken, we operate the first crypto derivatives regulated exchange in the UK. I've been doing so for about 5 years. Of course, with custody, it is a regulated product by its nature, and so we're bringing a product to market there very soon. I think track record and experience is a big factor. Due diligence questionnaires that institutional clients would send to potential venues or counterparties, ask about what is your experience, what's your history, what incidents have you how have those been handled, and I think there is no real substitute for experience in that regard. I think that's.
Laurence, anything to add there?
I wouldn't say anything to a risk management perspective.
Fair enough. Okay then, well, as we're looking to conclude the panel, if the panelists are happy with me to open up the floor to the audience if there are any questions. Otherwise, we can turn to the last question that I have lined up. No?
Seems like there's not a lot of regulatory clarity, but a lot of clarity within the audience.
Super. Well, hopefully that means that we did our job well. So if I can just sort of ask for some concluding thoughts on direction the industry is going in, but I actually want to hone a little bit on all of the rumors and the rumble around the Bitcoin ETFs. I know that that's sort of being marked a little bit as the next big catalyst or turning point that the industry has to look forward to. So, Chen, any thoughts on what the significance of that might be for us?
Well, it's going to be huge, in short. On this, the US SEC's rejection of Bitcoin spot ETFs is in some ways one of the reasons we as a company decided to focus on this question of market manipulation, because back in 2017, where these rejections were already happening, like being released, and they were very similar to what they are today, it seemed to us like something that was largely resolved in traditional finance, and yet for some reason the SEC was still concerned about market manipulation. I'm a bit in a minority camp within the crypto industry, where I actually believe that, I really hope they're going to get approved, don't get me wrong, but I believe that the SEC has been pointing out a true fundamental infrastructural challenge posed by crypto. These are the first non-physical assets that are not native to any specific exchange, and that poses a new kind of cross-market concern from a regulatory perspective. That being said, with all the progress that's being done, that's being reflected in the likelihood of an approval, and it's going to be massive because ultimately it's a multi-trillion-dollar market ETFs, a lot of that market, and we already all kind of established that there's interest in institutional adoption in crypto. It's going to be a massive, easy, safe, compliant, regulated way, and all of that money is going to have to be settled and resettled on crypto exchanges, creating new volumes. So it brings in credibility, it brings in volumes. And it's going to be a massive step forward for the industry that I think everyone is very excited about. Yeah.
Cool. I mean, I think this is a very interesting question and seems to be something that everyone's been talking about over the last few weeks. I think from my perspective, a Bitcoin ETF could lead to long and permanent structural changes to supply and demand dynamics. So we know looking into 2024, Q1, Q2, we'll see the Bitcoin halving or halvening. That will result in a structural reduction in supply. But when you look at Bitcoin ETFs from the demand perspective, it's an easy to access investment vehicle for both retail and institutional customers, without having to worry about the nuances of like holding your own keys, digital wallets, all of those types of things. So similar to how you see in the equity space, every week, every month, you have retail and institutional customers buying into index products, creating this long-term structural bias, 8% year on year, or whatever we know it in the S&P for decades. Even if a small portion of your overall allocation or portfolio allocation goes into Bitcoin ETFs in an easily accessible vehicle, you could be seeing structural demand come into the space. So these are personal views only, but I'm really excited to see how all of this plays out, and this could lead to a fundamental shift in legitimizing the asset class.
Yeah, I completely echo on your thoughts on a Bitcoin ETF and also the halving next year. But there's also been the Ethereum spot ETF filings just in the past week. So you've got Fidelity and BlackRock now that have filed for Ethereum ETFs. So all of a sudden you're just sort of into wonder how far down the list of cryptos are we going to see these potential spot ETF filings. But what I do think that we haven't touched on too much is the sort of technology play that you're seeing. So a lot of large payment institutions such as PayPal coming out this year with their stablecoin. You see Visa partnering with Circle. So actually there's a lot of industry that's sort of intertwined, but it's sort of everybody getting involved from that technology play I think is something that we're going to see into next year, as well as obviously the buzzword we've seen today of regulatory clarity. Hopefully that continues into next year, and we see more adoption on that front as well.
Yeah, I think it's absolutely a net massively positive thing if and when these ETFs get approved. And of course, I was on a panel last week with people from BlackRock and Citi, and the audience and the participants in the panels, speaks volumes about the maturation of the space and how seriously these firms are taking crypto. I will say, however, though, it's not as binary an outcome that people have been kind of giving the impression of. There have been exchange-traded products in crypto for a number of years. We have a subsidiary, CF Benchmarks, which is a regulated benchmark provider for these ETFs, and the CME futures, which recently surpassed Binance as the largest open interest in terms of the futures contracts. And so this is more of kind of a gradual things have been happening from my point of view, and adoption, not a binary event that everyone has to wait for.
Yeah, I agree with my panelist here. I think my prediction we'll see a Bitcoin and Ethereum ETFs in the next 6 to 12 months, probably multiple. I don't know about the other assets yet. I think the SEC is still trying to figure everything out, but BlackRock is a pretty smart company. I don't think they've ever got rejected. They know what they're doing. It's going to happen. And to everyone's point, it's another way for people to hold crypto, right? And most people don't. There's a lot of people that aren't ready for wallets, and that's just not going to change, right? Some people just prefer to do it with all their other stocks or whatever other portfolio they have. And if you can make that as simple as a button click on their existing platform, it's just a no-brainer for them, right? I mean, people that will never have bought crypto are going to buy the ETF, and it's definitely going to happen. And people that are holding large portfolios, it's almost foolish not to have a little bit in crypto. So you're going to see people that have large amounts of money move over at least a little bit into these assets as they get in this format. And then that's going to trigger all kinds of other things. So yeah, massive bullish on that. Again, that's my personal opinion, but I think it's very great for the industry.
Awesome. Well, I'm really glad to end on such a positive note. I want to say thank you to all of you for your thoughts and insights today. I found it incredibly interesting, and look forward to the rest of the afternoon at Finance Magnates.